Kevin, did you tune in to the State of the Union this week?
I did. I spent my evening listening to the state of things in our country, which maybe we won't comment on more broadly, but it was pretty light on healthcare, I found. I didn't know necessarily what to expect going in. There were some brief comments on insurers. Insurers are not popular at the moment. Not surprisingly, Trump made a point about how he's going to stop payments to the big bad insurer and give people money directly, which certainly sounds appealing to me at the thought of getting money directly. But it was very ACA oriented. He also made a few quick points on what you'd expect, pharma fraud. We obviously saw announcement the following day on fraud, state of Minnesota, my home state, unfortunately being right in the center of that. I it's going to be interesting to see how all of that plays out across the Medicaid front. What happens with those payments moving forward, and how we look at fraud more broadly as a country. I think I've been listening to NPR a lot recently. Clearly, there's fraud going on in the state. Clearly, it's not good. Question is what we do about it moving forward. But I know we were both spending a ton of time listening to the public markets earnings calls this week. It was a busy one, huh?
It was a real busy one. So why don't we start with the public markets? Humana sunk a little bit, though rallied a little bit later in the week. And the catalyst for that was a Barclays analyst by the name of Andrew Mock sharpened his pencil, dug into the AEP files, and said he's a little skeptical about their management's margin guidance going into 2026. What was your take on that?
It's sometimes it's hard to get your hands on the analyst reports, so I haven't actually seen the analysis behind it. But the public reporting that was like, "Hey, Mock put this analysis out there." It's for folks who are in the crowd of being skeptical of Humana's ability to achieve its margin in 2026 and move forward in the right direction. Logically, it tracks as to what you would expect would happen. So I don't know that I have a ton to necessarily comment on that front. You mentioned you'd heard from a few folks suggesting similar type analyses.
Yeah, I mean, being a health tech nerd, you sometimes get DMs from folks who don't want to share stuff publicly, and they will. And so this person in particular, just said look at break down trend assumptions, stars. You kind of do all of the math, and it seems like Humana should probably end up negative in their MA business. Now, they have said that they're going to break even, and I have every reason to believe that they will do their best to do that. I think that we've been talking a little bit about the sort of palace intrigue angle, and that Humana's investors are clearly a little skittish at the moment. I think actually everyone in the entire public markets is a little bit skittish at the moment, as we saw this week. And it's going to be interesting. So Q1 and Q4, if you think about the usual path of MLR for an MA plan, Q1 is usually relatively high, Q2 and 3 are lower, and then Q4 is the highest. You have to imagine that a hotter than expected Q1, stipulating that Q1 is usually hotter, is gonna incite some panic among the
sure.
Humana investor base. And so, that'll be interesting to see.
Yep. Not just for 2026, but then also the question too of, do they get it into bids for 2027 if 2026 is a mess? Because that is going to be there's a 2026 issue, and then there is a very large 2027 issue implied by all of this too, right? Which is, if you don't pull back, go back to that strategy conversation they were having in earnings, right? We'll see.
Next up was HIMSS. They reported on Monday. We talked about it a little bit this leading up to the grand roundup last week. I thought that you had a kind of a good point, not kind of, a very good point about the two paths that HIMSS might have taken. And, you said something along the lines of, if you blinded yourself and just were looking at HIMSS financial results, you'd be like, wow, this is a pretty good business.
Yeah. I mean, let's just talk about the numbers for a second without getting into the company, right? 2.3 billion in revenue in 2025, 14% EBITDA margin, growing to 6.5 billion by 2030, 20% EBITDA margin by 2030. It's trading at, it's down another 7% this week, right? So its market cap is currently 3.3 billion. Like if you told me, if you just gave me those numbers on a company, I would tell you they're easily worth 10 plus billion dollars, right? Which I think Hims was closer to its peak when the stock was trading higher. But like, that's a really impressive financial profile. You don't see that a lot in healthcare. Like those numbers are pretty incredible, which also seems to invite the point of how skeptical people seem to be of Hims management's ability to actually get there moving forward because of some of these strategic choices they've made, right?
Yeah. And it's a little frustrating because I was just listening to GoodRx's earnings call, getting ready for this, and they're increasingly starting to sound like what Hims could have been if they're building out these relationships with pharma companies and they're going to employers, they're going direct to consumer, and they're saying, hey, like we have doctors that we employ and we'll help you get your hands on prescriptions. And you're like, oh, that sounds like Hims. And they read out the conditions that they're focusing on. And you're like, that also sounds exactly like Hims. They did not mention peptides because, again, they are focused on servicing the pharma companies that are on their platforms. But this was like an interesting stat that they shared. So when the new Novo Nordisk oral pill was launched this week, that during that first launch week, 1 out of every 5 prescriptions that was sold by Novo was via GoodRx. And this is like a very good channel partner if you're a pharmacy or sorry, excuse me, a pharma manufacturer. So you imagine Hims going around a similar route with the head start, without the burden that GoodRx has of this you sort of complicated and messy pharmacy network and the subscription business that never really caught on and all of these other things that are kind of weighing GoodRx down. And you're like, wow, that would actually, that sounds like a $10 billion company with lots of room to move.
For sure. You know, it's interesting. It reminds me, a couple of years ago, I was talking to an investor about, they were looking at investment in a up and coming health tech market at the time. And they decided not to do it because the company was first mover in the space. And the general point was, Kevin, it's not actually a great idea, generally speaking, to invest as in first movers in healthcare markets because they spend so much money plowing the path for everybody else to then follow that it's actually a disadvantage if you're an investor. And I don't know how much that, generally speaking, holds true, but it almost reminds me of what's happening here in a way of everybody else is getting to benefit from seeing how Hims, generally speaking, seems to be fumbling the bag here. Like they had such an advantage. They should be able to chart the path forward. They can tell this narrative of their growth strategy. And this issue they're having with pharmaceutical companies and the approach they've taken to it just seems like they've played too loose and fast with the rules. And it invites a whole bunch of skepticism, which creates a huge opportunity for other players, whether it be GoodRx or Ro or other companies, to come in and benefit from that, right? And it was interesting listening to Him's narrative. Like the earnings call, they very much deprioritized the GLP-1 narrative, right? The whole narrative was, hey, we are treating a bunch of different conditions. We are helping consumers rethink how they interact with their healthcare in this country and internationally was now a big part of the story moving forward. And generally speaking, again, I buy that narrative, right? That they are driving that change in how consumers are thinking. They are driving more international growth via these acquisitions. That all seems right to me. The question internationally, they pretty transparently came out and said, we are buying up these markets. We want to acquire customers. We're not concerned about margin at the moment. They're not hugely margin negative at the moment. Like they talked about the eucalyptus acquisition, and that's not creating a huge drag on earnings going forward. but they're going to try to buy up these important international markets and then focus on growing margin in the future. Pretty rational thing to do for a company like that, trying to grow like they are, particularly in this moment. The question is if you believe their management team, right? Like I don't know.
Yeah. I think the other thing that, yeah, I always enjoy a little bit of financial engineering. And a year ago, Hims issued about $1 billion of convertibles. And the conversion price is like $75 a share. I think they're sitting a little bit below 15 at the time. If you're if you're an investor, if you hold those convertible notes, you're like, wow, we are really, really underwater, and this company continues to do things to make people with guns and badges angry. And if you're Hims, you're like, this converts, and we're going to owe $1 billion in 2030. We're a $2 billion company, and so it's like you go back a year and you say, do we really need to try and get this money so we can go on an acquisition spree, or do we go and we do the long, slow, hard building of the connections with the pharmaceutical companies? Because I think if you go back last year, there was probably a window for them to say, and you and I talked about this a little bit. The Hims story is actually pretty compelling to Novo and to Eli. If you say, sure, this is going to be your channel, we connect with the youths. Like we can be your in with the people who want function testing and whatnot. I don't know. There's this path not taken that is incredibly frustrating if you were an investor.
Yeah, for sure. I mean, we talked about this in the lead up to the call, right? You can see it in the retail market and kind of the sentiment shift that, like, if you look through Twitter or Reddit, the questions that were being asked of Hims, you can sense some tone shift in that, right? There's a little more, what are you guys doing here? And I don't know. It's going to be fascinating to watch. There is no more Jekyll and Hyde narrative to me than Hims at the moment, because all the tailwinds are headed in that direction, right? They talk about in their call, there are the three things we're focused on: diagnostics and wearable innovation. Yeah, that seems right to me. AI and how they're going to be able to change the experience via that. Yeah, obviously. And personalized treatments and how they're building out their compounding facilities to be able to drive that. All of those things, generally speaking, sound right. And if you're a believer in this abundant healthcare narrative of the future, and you've got a consumer brand there, there's a compelling argument in that, I think, to make that there is no better positioned brand to lead that than Hims. But and there's also this the side that is like, yeah, and the government's going to come down on them at some point, and they've pissed off pharma enough where it's like, I don't know.
Yeah, it's tough because when they're talking on their earnings call, the branding's good. The branding, like their angle, their pitch, the way that they talk is good. And if you're a consumer brand, that's really important. On the other hand, one of the things that they did not talk about on their earnings call is that in addition to FDA, DOJ, also the SEC is asking around about securities fraud.
Yeah. That Q&A, this is how much is going on in their earnings call. I completely spaced on that. That Q&A where an analyst is like, hey, give us the regulatory update. And the analyst asks for an update on DOJ, FDA by name. And Hims is like, oh, no updates. We haven't heard from them. It's all good. It's like, to leave out the fact that you had to put a footnote in your 10K that the SEC has reached out, that they're investigating you. Like, you should probably say that on your earnings call. I don't think it's a great idea to leave that detail out, right? Like, I don't know. What do you think? The investors, like the retail community probably isn't reading the 10K, but the investor community certainly is. I just don't get it. They're down another, 7% this week. And I think it's stuff like that that's driving it. Because if you buy the financials at all, it should be valued higher, right?
Yeah.
I don't know.
Bloomberg columnist Matt Levine likes to say that everything a bad company does is securities fraud because you didn't tell your investors that you were going to compound GLPs, though in this case they did. And so you can always, there's always security. So maybe they thought it was implied. A couple of quick hits. Option Care Health. I like to listen into them just to get a sense for what's going on in the specialty market space.
Yeah.
Their stock is, they have margin compression, and it's 100% because of one drug, Stelara, which is biosimilars are getting are coming in, and so that hurts their revenue, right? Because they buy the Stelara and then they sell it at whatever the list price is, and their margin because they profit off the spread of those two things. To me, that is interesting only insofar as we think about this theme about competition and how you actually lower prices in healthcare. It's like, yeah, you just got to get biosimilars in there. You got to get biosimilars in there as soon as something goes off patent. And the companies that it hurts, like Option Care Health, like it hurts, and they're trying to make it up on volume. But this is a good thing for overall spending in healthcare. And so it's interesting just how much one drug is messing with their entire model because it was such a blockbuster drug.
Mm-hmm. Yeah. Who's next? You want to do Fresenius?
Just a quick hit on Fresenius. I was like keeping an eye on what's going on in the kidney space, and they also reported positive operating income for their value-based kidney care segment. So both them and DaVita have very large and up to this point negative operating margin value-based care businesses. That's exciting. I think if you're interested in, dialysis is really expensive, and if you can manage that in a value-based care relationship in a way that's saving the government money and making you some profits, that seems promising. Mm-hmm. The other thing that they mentioned, though, which I always like checking in on, is they're penciling in about 150 to 200 million euros worth of headwinds from the enhanced tax credit expiration. And there's this incentive payment for part of the dialysis bundle and called for phosphate binders. And so they were like, yeah, the regulatory headwinds this year are like pretty tough because we got the expiration of the thing and the phosphate binder bonus is going away. So bummer for them.
Yeah, that's a bummer. I thought I heard you say euros, and then I'm like, I did hear you say euros.
Yeah,
I was not expecting to hear that word.
They're a German company.
Yeah,
and so they report everything in euros and then have a conversion factor that they apply. But
interesting. Yeah. So on the VBC front, Agilon reported this week.
Yep,
their stock's up 33%. I just checked again. Yeah, 34% on the week, which is pretty impressive after the year they've had. That has not been the general trajectory of the stock price. If you go back and look at the last 6 months or year-long trajectory, it was a good earnings call. I mean, they talked about how 2025 was a year of setting the stage for 2026 and beyond. They're getting back to break even EBITDA in 2026, which if you look at I posted this in Slack, they do their adjusted EBITDA bridge of 25 to 26. 25, their actual GAAP adjusted EBITDA number on the left side of the chart, they've got it almost negative 300 million. They then did some market exits. There was some prior year development in that. That gets them to 210 million loss as the jump off for 2025. So what they're really saying is they're improving $210 million on profitability for 2026. Still a huge number, right? That's driven a lot by medical margin. ACO REACH has an EBITDA hit because of recalculation in that model. So they're losing $20 million of profitability from that. Then they're increasing G&A by 30, or they're saving on G&A by $35 million bucks. So they have a lot going on. They have been recontracting their book of business. They noted that they exited payer contracts for roughly 10% of their MA book, which is fascinating because, so that's 50-ish thousand lives they said on their call. And I'm like, interesting. So if you've got a VBC primary care group like Agilon who's saying to whichever payer has those lives, and there are three largest payer customers, not surprisingly, Aetna, UHC, Humana. I think they're all, I was looking in their 10K. I think it's all between 10 to 20% of revenue for those three. So substantial customer base for Agilon. If you think about those 50,000 patients, and Agilon is saying we can't manage these patients profitably, we're exiting these contracts and backing out of that, and you think about the flow of what then has to happen. So those payers are taking that risk back on, right? There's no longer a percent of premium deal there, so that's now back onto that payer's books. And then if you're that payer, what are you doing with that risk? Are you transferring it to another value-based provider? Because if I'm a payer and I've got 50,000 members at 85% MLR guaranteed because I've got a global cap contract, and they're at, I don't know what, 120% MLR. We don't actually know that number, but something not great. That's not great for whoever's getting that risk. And it's indicative of that, the conversation about bad risk and the questions that Humana gets when it's growing, like, are you getting bad risk from other plan exits? And Humana doesn't think it is. It's going to be fascinating to see who gets that risk. So to me, that was like the most interesting little nugget in the Agilon call. If you're interested in VBC contracting, it is a really good call to listen to. Them and Evolent this week were both fascinating calls in terms of what's going on in the MA market, how risk is shifting over time, how these organizations are recontracting, and how they've been able to do that pretty successfully, which is also a really, like, I don't think we unpack it here on this, but unpacking how they've been able to recontract with payers so quickly and why payers have been so willing to recontract when I don't know that they necessarily needed to is an interesting dynamic in and of itself, for another discussion.
When you think about the market dynamics, I mean, we don't know what geography. We could probably scratch at the surface a little bit and try and figure out what geographies these are. But the other thing is, there used to be basically a long line of people willing to take risk, a long line of provider groups who are willing to take risk, and now that's thinned out quite a bit, and they're going to be a lot more choosy. Agilon is the one who a lot of people I think were planning on dumping their risk onto. And so, like, Privia is not looking at this and saying, yeah, we'll take an 85% MLR for someone who's doing 120% last year. So that's going to be where they end up. Like you mentioned, fascinating to think about. Is it some startup with a dream? Is it, I don't know.
Yeah, I will be curious to watch. Also interesting to note, so related front on this topic, Evolent did well during their earnings call. I was just looking at the latest on what their stock was up this week. My Google's going slow at the moment, so I don't have the latest number on that, but they did well in earnings. Interestingly, a big part of the story for Evolent and what went well for them during the earnings call was that they are seeing a ton of growth specifically in their oncology product offering. So they noted that Highmark Health, they called them out as a contract win on the earnings call, but they're seeing a ton of interest in oncology. And one of they walked through this scenario with a specific cancer tumor type where they're like, there are 200 care pathways today that currently exist, and we help manage that and narrow those care pathways down to a much more reasonable number. And I'm like, you can imagine in an environment where oncology trend is really high for these payers, they are seeking partners to manage it. It's really easy for me to envision a scenario where payers doing a buy build analysis on, do we want to go out and essentially own this conversation with oncologists in a market? And if the answer is no to that, okay, Evolent's a willing partner who's able to take on this risk for us and take that off our books, back to that conversation of good versus bad, so on and so forth. Now, Evolent itself has gone through a whole recontracting exercise as it had its own set of issues related to that, but they've got fascinating chart that they shared during their earnings presentation looking at the asymmetric risk that they now put in place. So they're like, Their expectation, I think, is for something like 103% MLR for the new cohort of growth that they're experiencing. Not the entire book of business, right? Entire book of business is performing better than that. But they're like, if we miss and we get to 110% MLR, so 7% higher than expected, that leaves us at a $13 million EBITDA hit. But if we do better and we see a 7% improvement, get down to 96% MLR on that population, we have 57 million of EBITDA upside organizationally in the year on that for 2026. And I'm like, you can see the actuaries going to work building these models and figuring out how to price this risk effectively, right? So it'll be interesting to keep an eye on those two narratives. But if you're following along in the VBC conversation, I would be listening to those earnings calls.
I'm curious who takes that heads I win, tails you lose kind of deal, right? I mean, if you run over the risk stuff and you get 100%, their downside's limited, but their upside is a lot higher. That seems like a great deal for Evolent.
Yeah, for sure. I mean, it's not an upside only deal for a provider, right? But it's not too dissimilar conceptually to that of, hey, I'm gonna take on some of this risk for you. I'm gonna help you manage it, and if I outperform, I'm gonna do a lot better. I don't know. To me, I can imagine if you're a payer, there's a math equation in there on what's the baseline, how much do you value the certainty around that oncology book of business when you're staring at that as a really high trend area of spend that you probably feel like you're not managing super well. Because like I gotta imagine the other part of this, Martin, is that one tumor type has 200 variations to try to manage. I gotta think most payers aren't sophisticated enough to actually stay on top of this as it's coming along. So it's an area where it's particularly well suited for a third party to come in and say, let me take this complexity for you, because like, are you going to build out the infrastructure to do that yourself?
Yeah.
So I get, like, it almost feels like Evolent's becoming an oncology focused company in their narrative. I think they said oncology revenue in 2026 is going to be 65% of their revenue.
Wow.
2025, it was 36% of their revenue. So that just gives some indication of how much that oncology book is growing over the year, which is wild to me.
This is the second value-based care oncology company we've heard growing a lot going into 2026. At JP Morgan, you listened into TimeCare's presentation, and they also backed up the truck and loaded on a ton of risk.
Yeah,
going into this year.
I think it was, what were the numbers? It was like 10,000 lives in 2024, mostly Oak Street going into Aetna. 2025, it was, I don't think it was quite 100,000, but it was close to that. And they basically grew in Aetna and added Humana onto that, which, again, back to the overall narrative, like if you're inside of Humana and you are trying to keep benefits flat and you are trying to manage these high cost trend areas, and you find a partner that can help give you visibility and certainty around, okay, here's what's going to cost us, and you've got some shared savings mechanism in that, you can price that out, right? And it becomes really straightforward to move that risk over. And then the question over time is how much margin is there? And this is kind of the VBC primary care conversation. We'll get to alignment in a bit. John Kao talks about how V28 took margin out of the supply chain and make global cap for primary care a challenge. At some point, that'll be the question for these markets too, right? Like how much room actually is there in there for payers to say to these groups, just take that, you know? I don't know.
It's called risk for a reason. And that's a perfect segue into Privia. What did Privia have to say besides just being a cash generating machine?
I mean, Privia and alignment, since I just brought them up, are the two most straightforward narratives where they have just been crushing it the last couple of years, right? I'm still digesting Privia's earnings call, given the swath of them that we've had this week. I think their stock was up 10% after earnings, indicative of how the market reacted to what they saw from them. It's come back a little bit today. My quick read of earnings, they continue to do exactly what they've been doing. Not a ton to report beyond they seem to be slowly moving more into VBC contracts, which makes sense as the tide's coming out. If you're able to thoughtfully take on risk, if payers are going to come back to the table and have that conversation and actuarially you can get confidence around it, I get why that's a direction they're headed. So it seems like they're performing well in VBC. Seems like they continue down the growth path. They've got this awesome slide they always do in their earnings materials that goes through year by year and the consistent growth they've had over time. And they keep chugging along. So I haven't gone through the analyst Q&A. That's always fun to listen to. I'm curious to see what the analyst asked about. But on the whole, it seemed like another really solid quarter for Privia.
Let's keep on the value-based care train and talk a little bit about the MA plans that reported. So Clover and Alignment both reported last night at the same time. I don't know if you had a chance to listen to Clover. It was a pretty typical story from Clover. They're guiding the GAAP profitability this year. They grew a ton. They expressed bullishness on being all weather, regardless of stars and the rate environment. That's something we heard from Alignment as well. Mm-hmm. Basically saying, we think we will get the effective growth rate and other people are going to get brought down to that 0.09% by their risk adjustment, like these risk adjustment updates. But where we're landing is going to be closer to that that effective growth rate of almost 5%. So, yeah that was the Clover story.
I was interested to hear Alignment, Clover, and Agilon all seem to hit on that kind of general theme of the effective growth rate, which is the starting point of the advanced notice calculation, right? So that was what, 5-something%. And then there's the risk adjustment changes and some other things in there to get down to the growth rate for plans, which was the 0.9% that everybody was talking about. The narrative, as I heard it this week, was different than the big incumbent public MA plans, which was, listen, we're not thrilled with the 5% effective growth rate. We think that should be a little bit higher. We don't think that's reflective of what trend actually is in the market right now. But we actually think we're going to be able to manage through the other stuff that gets it down to 0.09% because of our model and the way we operate. For Agilon, their narrative centered around, listen, everything we do is in-person provider visits. So the stuff that changes around how other types of visits count for risk adjustment and things like that, not going to impact us. We're going to be okay. Alignment and Clover, I heard similar narratives, not that exact scenario, but them saying, listen, we think we can manage through this. We've managed through it in the past. We're going to be able to manage through it well. So the number that is actually more relevant for us is that 5% number, and we'll make that work. And to me, it's, if I step back and I think about the conversation that I imagine must be having, that the industry must be having with CMS behind the scenes right now, I would be curious if there is this dynamic of the incumbents versus the insurgents, and you like Alignment and Clover are kind of the insurgents who are sitting there saying, yeah, like, we're going to play ball, CMS. We're happy to be along for the ride and trying to drive the change that needs to happen in the industry, presumably because it'll set us up well for future growth in the industry. And we are going to try to be the examples of the change that needs to happen. And we're going to let you then hammer the incumbents who aren't playing ball as much, which I don't know that that's what's happening, but it struck me as an interesting tone difference between kind of the two groups using that and the insurgent incumbent language we've heard from CMS leadership and others to describe the market.
You can imagine someone at the Medicare Alliance listening to that earnings call and going and like snapping their pencil. Because what you want when you're doing advocacy is a united front. You want everyone to be good coalition partners and to say it's grossly inadequate. You're going to strangle all of us. The Medicare Advantage is going to go away if you do this. And then you have Clover and Alignment being like, yeah, I mean, sucks for them, but we're fine. And that is not what the Medicare Advantage industry writ large was hoping going into the comment period. Like that is, if you are CMS and you want to keep the rates really low, you are going to just like play those recordings back and put them on poster boards and say like,
Yeah.
no, 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 they said it's going to be fine. Why isn't it fine for you?
Yeah. And think about the narratives behind all this too that aren't specific to Medicare Advantage, right? You've got the upstarts that are more tech forward, that are bringing competition into the market. You should want those organizations to grow and proliferate and there to be more of those. The interesting other side of that is how do you encourage more of that competition, right? Because you've only got two of those organizations. And we've had the conversation multiple times about how there are a lot of other companies in the space that might not make it through the next couple of years because of these changes. But yeah, there's always this interesting strategy game that happens in these conversations of you don't want to bite the hand that feeds you, to use that metaphor, right? So if you're a Medicare Advantage insurer, you don't want to be overly critical of CMS because you don't want to risk ruining that relationship. But striking that balance and that tone of being able to push back, it's gonna be interesting to watch how that plays out over the next couple months. It's gonna be interesting to watch how that plays out in election season. Like I think this is gonna be a big topic for everybody, I'd imagine. And it's gonna be interesting to see what happens from a benefits perspective in all of that.
It's also a lot easier to bite the hand that feeds you if you don't have defectors in the prisoner's dilemma who are saying, sure, I would never bite your hand. This is perfect.
Yeah.
Yeah. Speaking of, well, no, I don't have a good transition for that, but hospital operator UHS reported this week they grew margin and revenue. Kevin, do you want to guess if it was by volume or price?
I'm going to go ahead and guess price.
Yeah. So it was basically flat on the volume growth for the hospital business, and then for the behavioral health business, like 1.3%. What was interesting is they got some questions. They're saying, okay, prices are going to start to normalize. UHS said, yeah, prices are going to start to normalize here. And they're like, we think it's going to come from a more balanced combination of price and growth. And analysts were a little skeptical. They're like, okay, but look at your growth recently. Like, if we can't count on the prices to get us there, then where does that come? Reading through the financial release, there was also a fun note. It said, an after-tax unrealized gain of $71.5 million, or 1.13 per diluted share, recorded in connection with our minority ownership in a healthcare generative artificial intelligence company, which is Hippocratic AI. I think the timing of the rounds and when they would have had to report it and the size of the increase points to Hippocratic AI. It is funny that a criticism that I make of regional nonprofit hospitals with too much cash is that they get into speculative venture capital investing, and it would just be better if they, were having to return that cash to shareholders. And then you've got UHS holding on. It's an unrealized gain. So holding on to their Hippocratic AI. And you're like, well, okay, I guess I can't point to the private or the publicly traded hospital operators as the good stewards of capital anymore, at least in this case.
When it works, Martin.
There's this funny theme that's emerging probably elsewhere outside of the hospital operator market, but I'm hearing it mostly when I'm listening to the hospital operators, which is the analysts are starting to say, okay, so where are the financial benefits of these AI investments going to come? Mm-hmm. And the management team always has lots of very good, plausible answers. They say, here and here and here and here, but it's never reflected on the financial statements. And I am curious, like, when?
You're asking the wrong person. I mean, we've talked a lot about AI this week, right? Obviously, the Centrini. I don't even. I feel like I've said that name a lot this week and changed how I say it each time. I'm still not certain of how it is properly pronounced. Obviously, there's the doomer narrative that came out on Monday that sent the stock market down about how white collar jobs are going away in 2028, and that's going to tank the market, and nobody's going to be able to pay for their mortgage and whatever else. I don't know. I find the much more reasonable take to be the Citadel came out with a response. We were talking about this in the community. I read through that, and the response is basically like, there is no data suggesting that's actually going to play out. What is actually much more likely to play out is AI is going to be the thing that helps our economy get through some challenging headwinds that we are facing with an aging population and so on and so forth. And it'll keep GDP growing at 2% a year as it has for the last 150 years. And that is what technology has always done and likely will continue to do. And I'm like, yeah, as somebody who generally is a fan of looking at history to see what's going to happen in the future, that seems right to me versus have you seen the Financial Times chart that's been circling about that GDP growth number at 2%? And then there's the AI things that go to zero or go to abundance and GDP goes through the roof. And I'm like, I don't think the most compelling narratives I hear around AI are the tangible use cases of, yeah, we're gonna make these tweaks and we're gonna be at the high end of our margin profile as a result. I'm like, yeah, that seems right to me. Like maybe there are gonna be a couple jobs here and there that are gonna be automated and displaced, but this like, what is it? Was it Block? Was that the public company that got rid of 6,000 jobs? And there are all these tweets talking about how, yeah, you can get rid of 6,000 jobs out of 10,000 if you're Jack Dorsey and you've been mismanaged your company since COVID and hired thousands of people who you didn't actually need. It's like, yeah, there's a nice narrative there for management teams that can CYA by saying, oh yeah, this is AI disruption, Martin. We needed to make the change now because believe you me, it was coming.
Yeah, I think, there's the joke about you can see the computer age everywhere except for the productivity statistics. Like you look at the GDP growth and it's always about 2%, and you need to run as fast as you can to stay in the same place and get that 2% because stuff gets competed away. There was a funny anecdote in Money Stuff this week talking about how investment banks aren't hiring, private equity shops are realizing that they don't need analysts for leverage buyout models because Claude can do it just as fast. And Citadel, not Citadel, well, yeah, Citadel and a couple of these other hedge fund platforms are starting analyst programs and bringing in new people because the hedge fund model has changed from swashbuckling, sort of Bill Ackman types to figuring out clever liquidity trades like the basis trade or, like long short stuff. And they can teach that. And so they're bringing in all of the people who would have gone to Apollo are just like going over to Millennium and Citadel. And yeah, that's how technology's always worked. And there's some because we're recording this on Friday, but this is going to come out on Monday. You put a poll in the newsletter about what we think the impact will be on healthcare jobs in 2028. And it's like, I am smashing the button that says higher. We're going to employ a higher percentage for both white and blue collar because that's what's always happened in healthcare. And so much of the AI doomerism comes in with this idea that we're going to suddenly be content at exactly like the consumer satisfaction is going to be content at the point that it is at right now with no sort of future growth. And that I have some bad news for those people.
Yeah, I do think it is interesting to think about if we were writing that sort of a report for what 2028 looks like for healthcare, thinking about the various scenarios across the industry, I do think is an interesting thought exercise to see where you land out personally. Like I can see the hey, we've got tens of thousands of people in a call center. Maybe we don't need those tens of thousands of people in that call center anymore. Maybe we can get that down to 5,000 people and they are more efficient using AI that doesn't get stuff wrong. That might be change that happens. And we might have to, there might be displacement in the labor force in that regard that they need to figure out how to be reskilled, find new jobs, et cetera. But to your point, I think history shows us time and time again that in this world of abundance, there's that Jevons paradox or whatever it is, right? We're going to see more employment result from this. And that seems pretty straightforward to me. I'm not necessarily all the way in the A16Z put out their infinite healthcare report this week. To me, kind of both sides of the equation seem equally unlikely. We're going to see some improvements from AI. It's going to be a great tool. It's going to change our lives for the better in ways that I don't think we can imagine yet. And it's also things are going to remain the same in more ways than we can imagine. This is going to be in the newsletter too. Ben Affleck's take on AI to me is the best take on AI. And I did not expect to be saying that, right? But it's a very rational, yes, it's going to change things. But the things it's going to change are like when Audrey Hepburn was in a movie decades ago and you had goofy backgrounds that were floating around, they're going to be better backgrounds and we're going to be more efficient, but it's not going to fundamentally change the industry and put people out of jobs and so on and so forth. So I don't know. I get tired thinking about the AI topic.
Yeah. I think that that report was the end of me mulling that over because there's not much more to add besides ATMs and bank tellers and, the productivity statistics and the computer and the internet and the fact that OpenAI is round tripping a bunch of revenue and selling stock to Thrive at a third through complicated call options, selling Thrive, which is a owner, but also OpenAI is an investor in Thrive, is selling itself. Anyways, this is way outside of healthcare. Allina Healthcare, your former employer, had a story this week.
Yeah. To me, this is actually a good transition from AI conversation back into healthcare AI. It's when I think about access, we've been talking about access a lot recently. It is a good example of what I expect to be partnerships activity that we see kind of in the access realm of the world. So Allina has a cardiology group called MHI, Minneapolis Heart Institute. I think Minneapolis, maybe Minnesota, whatever. Let's go with Minneapolis. Very innovative cardiology group, kind of one of the crown jewels of a system like Allina. They announced a partnership with Innovaccer, which acquired a company called Story Health, which does virtual heart failure cardiology models. To me, if you think about the general narrative for a program like Access, we want to encourage more technology-driven care in a cost-effective way for a large portion of the Medicare population. We want to work with the industry to help drive adoption of this. It's a really logical way and partnership for that to happen through, right? Have an incumbent organization, a group of very highly respected cardiologists in a major metro area in this country, referring out to a virtual tool that allows them to manage a broader population at lower cost between visits. All the things we have always wanted from digital health for healthcare. If this is the unlock and that is access related and Allina is doing it in part because access incentivizes that behavior and makes it a win-win for everybody, that's really cool. I think that is a really good example of the change we should applaud and be looking at as a cool example of where the space might head. Now, who knows if it takes off, and there's always risk in these partnerships and so on and so forth, but I thought it was really cool to see. I was proud of my former employer for getting out in front of something like that.
Yeah. Last thing I wanted to chat about quickly today was 340B. And there's been increasing attention to 340B this week. So I thought I'd just do a quick sort of level setting on what 340B is, and we can talk a little bit about what's going on. So 340B is a program that HHS has for a specific group of hospitals and care providers, and these are safety net providers. So it's community health centers and safety net hospitals, rural access centers, Ryan White AIDS public health stuff, right? And what it does is it allows those eligible facilities to buy outpatient pharma drugs, so like stuff that you would normally buy at the pharmacy at a low price, and then sell them for usually a profit. And so USC Schaefer Institute kind of talks about how, if you think about $1,000 drug for an uninsured patient, the eligible entity, the 340B eligible entity makes $0. They don't have insurance. For a Medicaid patient, it's $1,000 because it's supposed to kind of net out for a Medicaid patient. But then for Medicare or a commercial insurance, like the eligible 340B eligible facility is allowed to make a profit on that. And so for a commercial patient, it can be up to like $3,000 for a $1,000 drug. It's like a nice little revenue stream for these safety net hospitals. And it's one of those things that drives everyone in healthcare crazy because it's a kind of, bank shot way to finance safety net hospitals. We say we're going to give these set of hospitals, we're going to allow them to be in the pharmacy business and make profits at the expense of the pharmaceutical industry, as opposed to just paying for the rural or the safety net hospitals, like financing them or subsidizing them. And the thing that's interesting to me about 340B is that, when HRSA, it's like the Health Resources Services Administration, part of HHS, they say that the point of this program is to enable covered entities to stretch scarce federal resources as far as possible, reaching more eligible patients and providing more comprehensive services. They're not saying like you should take those drugs and give them to patients. This is a discount program. This is specifically a financing mechanism for eligible facilities. Pharma companies hate it because they have to sell these drugs to these facilities at a massive discount. But it's not like these pharma companies are like totally heartless or anything. Because if you are in the business of being able to buy something for $1,000 and sell it for $3,000, like people are going to rush into that trade all day. And so not safety net hospitals will buy safety net hospitals, and then they have access to the 340B discount program, and it drives the pharma companies nuts. So last year, HHS rolled out a pilot program that instead of saying, okay, the way 340B works today is they say basically, I'm going to give you a discount when you buy the drugs. And they rolled out a pilot saying, in fact, you're actually going to get a rebate. So you're going to buy the drugs at the full price at $3,000 and then sell them. When you sell them for $1,000, we'll give you a $2,000 rebate. And people got really angry. All of the people who rely on this financing mechanism were like, well, what if the pharma companies don't allow me, like they deny the rebate? I have cash flow problems. Most of my patients are uninsured or on Medicaid. So if I'm paying full price, and a court blocked the implementation of the pilot. The way that they blocked it was not saying, well, this goes against the intent of the 340B program. They said you didn't follow the Administrative Procedures Act. You didn't request comments. You just rolled out this pilot. And so now HHS is asking for comments on the pilot. The comments you would imagine are going to be mostly negative from community health centers and hospitals and the people who are benefiting from this program, and very positive from the pharma companies. And that's kind of where we're at today, is the question of like, what do we do with this program, and the second order effects of how do we finance safety net hospitals in this country are, it's like in the hands of the folks at HHS. And it's one of those things that's maddening, because you're like, yeah, the pharma companies are right. Like it is bad that regional super monopoly hospitals have like a huge line of business just doing 340B stuff. But also, what's going to happen if you make it harder to finance safety net hospitals is like those safety net hospitals are just not gonna be able to
Sure.
operate.
It strikes me as one of those. The hard part of this isn't figuring out, or like you and I could riff and think about what would be a better system and better structure. And yes, like get rid of 340B, subsidize safety net hospitals, change a whole bunch of stuff and move. Like why are we doing this? But it strikes me that the challenge in all of this is if you're at HHS, you've got to balance all of these stakeholders in our political process. And that is actually by design, right? So we can't just have these massive changes. And how do you do it in a way that actually appeases all the various stakeholders involved in this? Because to your point, like not fully understanding all of the 340B mechanisms, but looking at it from the outside, it seems like when it was created 30 whatever years ago, the intent of supporting safety net hospitals, like I don't think anybody's going to disagree with that. It's been used differently over the past decade as it's grown, obviously too, right? But like, how do you effectively rein that in? I don't know. It reminds me of we were talking to Lawson Mansell about the No Surprises Act and the IDR process, and it's kind of the same thing where it's like the IDR process seems broken at the moment in the way it's being used and how quickly it's growing and the way the outcomes are occurring as part of that process. The regulatory fixes for that, the most likely thing seems like it is to make that process more complicated, to add into the complexity, to change some of the ways in which it happens. When the real fix is probably like why do we need an IDR style process in the first place, right? But that actually isn't a productive thing to suggest in the political world because it's just like it's an alternative reality that doesn't actually exist, right?
My opinion on the IDR process has changed because I recently picked up a sideline doing IDR arbitration, and so I'm actually really for IDR arbitration now. I'm gonna go grab like the 20% of the millions and billions of dollars. So I'm actually busy starting next week because I got training.
I like it. Entrepreneurial, Martin.
I just to put a point on this, there's all sorts of these financing mechanisms in healthcare, and you know this current administration has been kind of going after some of them. So 340B is one of them. State directed payments. You know,
Yep.
UHS was talking about how for them, without state directed payments, outpatient behavioral health is much more profitable than inpatient. And they plan on making hay while the sun shines, while those state directed payments are still in place, but then tilting their portfolio towards outpatient in 2028. And, you know, it's like we were paying for some amount of behavioral health through these state directed payments, and we're not doing that anymore. Same thing with provider taxes. And yeah, it would be simpler if we could just say, no, we're going to raise some people's taxes, and then that's how we're going to finance these safety net hospitals. But we don't live in that world, and so you kind of have to lean into the complexity a little bit and say, okay, well, let's at least make sure that the results that we're getting aren't overly perverse.
Mm-hmm. Sage advice.
All right. Well, I think that's it for today. Thanks for your time.
Fun. Have fun on your IDR process endeavor.
I'm going to rule with the providers 88% of the time because that's what's always been done. That's my plan.
Sounds like a good way to capture some of those administrative dollars going into the program.
All right. Thanks, Kevin.
See you, Martin.